We just heard about a day ago that Canadians are optimistic that residential real estate prices are going to go on rising. Let's get a broader look at real estate investing, where that market is headed in the new year. Our guest is a real estate specialist, Andrew Moffs, Senior VP and Portfolio Manager at Vision Capital. Andrew, it's great to talk to you again.
Thanks for having me on.
Andrew, just give us, I mean, obviously real estate, there's so many different flavors. Broadly, though, low borrowing costs are great for the sector.
Absolutely. I mean, that stat that you just said about home prices, low rates is the #1 factor that's providing that optimism. But it's true for all real estate, and we focus at Vision on commercial real estate. When you have low rates, you have the ability, of course, to borrow more cheaply, and that spread between the rate that you borrow at and the capitalization rate, meaning the going-in yield when you buy real estate, that spread between the two is what commercial real estate owners care about. So when your liability side is lower, that's a good thing.
What are you doing? I guess the big question is, what about real estate exposed, retail exposed real estate? RioCan finally pulled the bandage off, cut its distribution there before the holidays. Are you interested in any retail REITs at this stage?
It's really a risk-reward question. We thought it was a prudent move by RioCan. We actually owned the units of the REIT prior to that distribution cut because we thought the market had appropriately priced it in. At this point, I think it is a much tougher paradigm owning retail stocks today. I think you're far better off looking in other sectors, the other winners post-pandemic, whether it be different types of residential real estate, whether it be industrial warehouse real estate. I think from a risk-reward perspective, you're much better off in those sectors.
What about RioCan? You said you did own it before the distribution cut. Have you sold it?
Yeah, we certainly trimmed our position. The stock actually rebounded quite nicely after the distribution cut. We had bought it far lower than where it is trading today. We think the worst is behind it in terms of that kind of negative news, but it's a much tougher leasing environment going ahead. So it's great. We have light at the end of the tunnel with all this great news about vaccines. But it was already a tough leasing environment for retail prior to the pandemic. So it's not really a big bet we want to make at Vision. We believe we're better off in other sectors, like I mentioned.
That's interesting. But even prior to the pandemic, with digital shopping, Amazon, etc., it was tougher for retail.
Absolutely. I mean, department stores, it was always a question of when the lights would go out, and it was almost death by a thousand cuts. Finally, you've seen the demise of many department stores, and they're obsolete. That real estate will really take forever to lease up. I mean, previously that space was being taken up by restaurants, by gyms. And if you think about what the pandemic has taught us, well, now I have more space in my home to work out and use my Peloton. I'm cooking in my kitchen more, or I'm bringing in food a lot more. I think lifestyle is going to change. There's going to be positive and negative ramifications from the pandemic. And I think overall, it's going to be tougher for retail and office.
Talk to us about residential. What residential names do you like right now?
We're very bullish on the U.S. Sunbelt. So those are states like Texas, Florida, Tennessee, any place that has a low-cost jurisdiction where you're seeing employers who are already doing this pre-pandemic leaving high-cost centers. Think of San Francisco. Think of New York. We're very bullish on companies that are focused on those low-cost states. So two stocks that we really think will do well in 2021. One is Tricon Residential, ticker TCN on the TSX. They're focused on the single-family residential sector where they own homes, single-family homes, and rent them out. And then the other stock we're very positive on is BSR REIT, ticker HOM-U, the home units. They focus on multifamily apartment units in the U.S. Sunbelt. Again, focusing on Texas, focusing on workforce housing, where people can both work as well as have an affordable rent that they can cover in order to live in a state where they actually have no income, no state income tax.
And just remind us, the money your clients own those two, I'm assuming. Do you yourself own either stock?
Personally, I do not, but I'm very much invested in our funds. All our clients own these stocks. These are two of our larger weights in our fund today.
CapREIT, the giant Canadian apartment player, you think that one has decent prospects as well?
Indeed. The pandemic temporarily hurt immigration to Canada, both from new immigrants coming to the country as well as foreign students coming to study here in Canada. As I mentioned, with light at the end of the tunnel and the federal government's commitment to immigration coming back in the latter half of 2021, we think CapREIT, Canadian Apartment REIT, tickers CAR-U. We think they're very well positioned to take advantage of, the return of positive demand factors in Canada. They're very focused on the key urban centers, and that's really where immigrants and students are coming to. So with, call it 40% of their portfolio in the GTA, we think CapREIT's very well positioned. This is a great management team and a really solid portfolio with rents that are below market.
Although you do note that the slowdown or the near halt in immigration is going to be a headwind. And you say that we are seeing in Toronto significant carrots being given to tenants, inducements, you reckon for the first time in 50 years?
Yeah, it's really almost unprecedented to go around the city and see signs for first month free. It was unheard of a year ago. A lot of that is promotional, and a lot of that, we feel like we've hit the bottom. The great thing about the public markets is very different than the private market. The public markets discounts all of this, and we believe CapREIT is trading at a discount to its net asset value. So we've already taken in the brunt of that pain, and now we look at the future and say, wow, look at this. There's a lot of potential here for income growth in the future, let alone the reversion back to net asset value for the units of CapREIT.
What about the self-storage industry? I'm trying to think. I don't know. Is there a major self-storage stock in Canada? I'm sure I've just forgotten. But you think that self-storage industry has promise right now? Tell us why and give us a stock idea if you have one.
Absolutely. So we are bullish on the self-storage industry in Canada. The best operator, publicly traded storage vault, ticker SVI on the TSX Venture. This is a large position in our fund. We're bullish on the sector because it is many years behind the United States in terms of acceptance of the product, in terms of consolidation of the industry. So what do I mean? In the United States, we have about 8 square feet per capita of self-storage space. In Canada, it's only 3. Yet there's really little distinction between Canadians and Americans in terms of the stuff they accumulate and the stuff they need to store. What's great about this business is that it's very recession resilient. It's always life events that cause one to have to take up self-storage space, whether it's death, divorce, move in, move out, and all that occurs whether or not the economy is strong or weak. And what we like about Storage Vault is that it trades at a discount to its net asset value. That's a core principle of vision for us, trying to find stocks that are cheaper in the public markets than the private market. And we think there's tremendous growth. This company is great at rolling up mom and pop and bringing a little sophistication to this industry.
That's interesting, yeah. And Storage Vault, so on the venture exchange, SVI. Okay. Andrew, we could talk to you about real estate all day. It's such an endless topic. Thank you very much indeed for joining us.
Thanks for having me.
Andrew Moffs of Vision Capital.